Treasury yields may be down, but concerns for growth are on the rise. With a Fed that is digesting a ton of data and a lot of unknowns within the policy realm, how should investors be thinking about investing in the fixed income space? We're going to get to that and a whole lot more right now on UBS Trending. Hi, everybody, and welcome to UBS Trending. I'm Anthony Pastore. Thank you so much for joining me today. My guest joining me for this conversation is none other than Leslie Falconio, the head of taxable fixed income strategy with the Chief Investment Office. Leslie, always a pleasure. Good to see you, my friend.
Good to see you.
So, Leslie, I want to get right to it because there's a lot to talk about within the fixed income space. I alluded to it right in the intro. We're looking at the Fed, we're looking at a lot of economic data, and we're looking at Treasury yields that are starting to come down here a little bit. So the first question I want to always get to with you is the sentiment shift. It seems to be that growth concerns are now starting to creep in. Inflation is still a concern, but maybe growth is overtaking that. And why do you think Treasury yields are coming down? What's the shift? What's going on?
You know, listen, look, fixed income investors have become accustomed to shifting narrative, right? We've seen it so many times in terms of, recession, soft landing, hard landing, no landing, but now we're really facing this again in terms of this, what I call a bit of a February fade. And what I mean by that is, we know that in January, we saw this really large rise in interest rates. The 10-year yield got to 4.80 mid-January simply because of the rise in inflation expectations, the impact that potential tariffs might have on inflation. But sure enough, I mean, as we head into February, a lot of this has faded and sentiment has shifted. Where now, because of some weak PMI numbers, very weak in terms of the sentiment, even though we don't think sentiment is necessarily a great indicator of future economic fundamentals. But these sentiments, indicators are starting to weaken. That the economic surprise index is going negative. So we have a lot of shift in terms of how the market's, perceiving inflation versus growth. And one of the real ways that we will see this, Anthony, is that if we look at, say, January, that rise in nominal yields was really the rise in real yields was the tailwind to that rise in nominal. When real yields rise, it's really due to growth. Now we're seeing the exact opposite. Nominals are falling, and it's because real yields are coming down. So a lot of this has to do with just the fact that people are reevaluating the growth outlook simply because of this uncertainty, simply because the potential tariff policies might slow growth, which we know that they will in the latter part of the year. And also, too, when we're seeing what's happening with the equity market and some of the corrections that we're having in the equity market, this has also been a tailwind to interest rates coming lower.
All last year, you and I essentially were talking about our inverted yield curve. It de-inverted a couple of months ago, and now, as you just said, it's flattening again. Is there a chance? I mean, obviously, there's always a chance. What's the likelihood of it inverting again?
Well, the 3-month tenure actually got inverted a bit, right? But listen, I think we've all, at least I hope we've all, learned the lesson that inverted yield curve does not cause a recession. It's a coincidence indicator because right, we had 2 years of yield curve inversion and no recession. And, I think, while we had a slight inversion with the 3-month tenure, I really think in order for the yield curve to invert for a sustainable period of time, you'd have to be in a stagflation type of scenario where inflation's moving higher, the Fed is staying on hold for longer, potentially even hiking, not our call, and that long end is coming down because growth is coming down. We don't really think that stagflation scenario is our call right now, particularly with how strong the labor market is. So we are expecting the yield curve to maintain an upward sloping bias, but it won't really start to that. We won't really have that bull steepener until the second half of the year when the Fed starts to cut, in our opinion.
So let's get to the Fed for a second, Leslie. I wanted to kind of give a little bit of an update to our viewers. There were two Fed presidents that spoke recently. Kansas City Fed president said he's less optimistic on inflation given the possible tariff impacts. And then the Cleveland Fed president said inflation coming down to 2% is far from a certainty and upside risks abound. Given that we have a Fed meeting coming up in just a couple of weeks in March, and our CIO view is for 50 basis points of cuts this year, what do you expect to hear from the Fed in that March meeting? And when might we start seeing these cuts begin?
Well, listen, in order for them to cut in March, you really have to see a very, very poor non-farm payroll report. And even that situation, I don't think that they would cut because it would only be 1 month. So our expectation is that they don't cut in March. And we do have a new SEP or summary of economic projections come March, right? It's a new quarter. So I think it's going to be interesting to actually see that new information. But I don't really think that they're going to change in terms of the two cuts they have priced in, that they alter that. And that really is similar to what our view is as well as Anthony. I mean, we do think that the Fed cuts twice, this year in the second half of the year. We don't think they move in March. And when you talk about that 2%, you have to remember they moved that 2% target in the last SCP from 2026 to 2027. So it's they're not in their own forecast. They don't expect to see that number until a couple of years out. But it's really that trend that they need to see, that trend that they need to continue to see lower. And what's happened is, as we know, and as we saw in January, right? A lot of this short end inflation expectations, break even inflation expectations have really moved higher because of the impact that tariffs have on inflation for the short term. Now, we think that the Fed will look through that, but given the fact that we've had sort of parts of stagnating inflation, meaning that it hasn't gone down, it's kind of stayed steady, it sort of exasperated the issue that the Fed is now really paying attention to if inflation stays higher for longer, and not just targeting the 2%, but stays at the level where it is. Our view is the disinflation trend, while dented, is not derailed, and we think it continues throughout the year, particularly when we look at things like owner's equivalent rent.
Right. And if you look at the investing side, it seems like a lot of investors are long risk assets, or at least it appears that they're going that way. Given that, should investors be concerned that a lot of folks appear to have a similar risk on allocation right now? What are your thoughts on that?
There's no question that individuals are long risk assets because you have fixed income and equity, both at relatively full levels, right? And you're seeing that they have risk assets simply because the negative correlation of total returns between fixed income and equity, has come back, right? So as the equity market has a negative total return, fixed income has a positive total return, which is what we expect to see, right? And that's really been an important part in terms of, avoiding that 2022 scenario, avoiding a point in time where both sectors are moving lower and interest rates are just, moving up, right? Which would really be restrictive for both sectors. But you could tell this risk on scenario because you have a little bit of that net correlation coming back to what has been historically. And also, too, when we think about the inflows that we've seen, since the election, a lot of the ETF inflows, particularly this month, have been into fixed income, right? It wasn't like that in January. Since the election, it's really been about the equity market. It's been about growth, potential tax cuts, and all that. But in the short term, it's been about fixed income. And that's simply because we're going through this period of volatility. We don't think it's a situation where we have a hard landing or recession. We're looking for growth to slow, but move to trend or slightly above. So we think the equity market, while just having a pocket of vulnerability, is really our preferred sector over the year. And we do think that while we've come down in interest rates, and you have to remember, Anthony, our call for interest rates in the first quarter was 4.25 10-year yield, right? We were just 4.80 in January. Our call for interest rates at the end of the year is 4%. So it's not as though we're looking for this large price appreciation from 4.25 to 4%, but the difference being, and the important part is that you're going to have volatility in between that. We'll see if we have a likelihood of seeing 4.75 than 10-year yield again. And what investors can do is take advantage of that by adding on to interest rate risk, right? Adding on some credit spreads as they widen out. But we've had a big move from 4.80 to 4.25. And now we're going to be steady for a while, but it most likely will go back up again, we think, assuming that, and our expectation is that growth remains above trend.
Right, exactly. And just as a reminder, I think you mentioned this as well, back in September of 2024, the 10-year was sitting at just above 3.5%. So obviously it's been a wild roller coaster, even compared to where we sit today. But as you said, end of year target, 4%. I wanted to ask you though, Leslie, so I read a recent report that you wrote, that you co-authored, talking about obviously that CIO remains long the belly of the curve, which is that 5 to 7 year part of the curve, but you're taking gains on some of those 5-year Treasury longs. Given that and the positioning, are there any risks that you see to that current positioning?
We don't see risks in terms of our year end. I mean, again, it's not necessarily the end of year target, but what investors do with the volatility in between. And you're going to see that volatility, right? As there's so many unknowns out there, right? I mean, hopefully by April 15th, around that, second week of April, a lot of those unknowns will become known, but you're going to have volatility. So we just trimmed a little bit that long in the belly that we had simply because we'd come down from 480 to 4.25 in 10-year yield. We'd gotten around a 405 in 5-year yield, which is, fairly low from where we were during that election time when we, initiated the allocation, but we still remain long in terms of our interest rate exposure, but we're not really getting over the skis in the interest rate exposure. And what I mean by that, Anthony, is that we're staying in that intermediate part. And when that time comes, which it could very easily, that we go back to that 480 and 10-year yield, we would then, extend out and add in our interest rate exposure. But for now, really the concept, the tailwind to your total return is income and compounding income. It's not going to be about price appreciation at a 4.25 10-year yield. It's not going to be about spread compression. It's going to be about compounding income. And that's why we stay a little bit with the higher quality. We are diversified. We've taken off a little bit of our, belly exposure, if you will, but we still think that interest rates will be lower by the end of the year, but not necessarily in a continued straight line.
Right. So you are trimming some of that exposure then, right?
That's right. We trimmed some of it because we moved from 480 to 4.25. We reached our first quarter 10-year yield target of 4.25. Now we're just gonna we wouldn't sell it, right? So we're gonna keep our long. We're gonna take a step back for a bit, see how these next couple weeks are going to play out with all the information. We know that at some point this year, interest rates are going to rise back up again because we don't believe in a hard landing. We don't think that growth, moves substantially, say, below trend. And we do think the labor market is still solid, right? Regardless of what the sentiment indicators are saying, it's really about the labor market, which still remains, while softening, is still strong. So we wait for a better opportunity as interest rates rise to add that exposure back, right? And that's exactly what we'll do.
Excellent as always, Leslie. Thank you so much.
Thank you.
Great. Leslie Falconio from the Chief Investment Office here at UBS. And for more information on anything that Leslie and I spoke about today, plus all of the other views coming out of our CIO, you can visit our Insights website at ubs.com/views. Plus, you can follow UBS on social media. We're on all the major channels, LinkedIn, Facebook, as well as Instagram. You can follow UBS Studios at our account at UBS Trending. So take a follow there. And as always, if you have any questions about your portfolio, make sure you're talking with your financial advisor. Until next time, I'm Anthony Pastore. Have a great rest of your day, everyone. And remember to keep your eyes on what's trending. We'll see you soon.